Hey guys, it's Ken. So obviously there's been a lot that's gone on this week with first GameStop and now Silver, American Airlines, AMC. Like there's all kinds of stuff going on. So I wanted to talk a little bit about that because I was having these conversations with my friends about, what's tangible and what's intangible. And the difference is, of course, is what's tangible is actually physical presence, and what's intangible are things that are not. And so what's happening right now is a lot of people are scrambling and grasping for things, in my opinion, that are intangible. And there's all this market manipulation going on right now. This has been going on for a long, long time. And this is probably the entire reason that I love to teach on this stuff, because if you guys can move your thinking process over to the tangible side, I think that you'll be a lot less concerned, have a lot less stress and anxiety, because for me, I'm falling back on the cash flow from my properties, the physical part of my properties, the money that I have as far as gold and silver and physical assets in my safes and the things that I've been collecting for years. So hopefully you guys are thinking that maybe you should be thinking about tangible assets on this side of the equation. That's why I don't have a lot of stress and anxiety right now as I watch all this stuff. I think it's fascinating, but the last thing you want to do is be over here in a big way. I'm not saying it's kind of fun to be over here on Bitcoin or any of this stuff, but you want the majority of your assets over here on the tangible side, on the physical asset side, like real estate or physical gold or physical silver. And guys like me and guys like Robert Kiyosaki, we've been doing this for years. So I have hundreds of thousands of dollars in silver and gold, in physical silver and gold, and of course millions and millions of dollars in real estate. But I also play over here. And I think that the people that are getting hurt the most right now have the majority of their wealth over here. So we're going to talk a lot more about this right now. So first we're going to talk about what's the difference between a tangible asset and an intangible asset. And what we have here is the primary difference between tangible and intangible is that tangible is something in which a person can see, feel, or touch. Thus, they have a physical existence, whereas intangible is something which a person cannot see, feel, or touch, and thus do not have any physical existence. Now, in this particular example here, we've got furniture, building, machinery, cash, vehicles, computers. On the intangible side, you've got goodwill, patents, self-developed software, brand value, logo, copyrights, trademarks, things like that. But on this side as well, I would actually put Bitcoin, stocks, and those kinds of things, because you cannot actually feel and touch those. Now, there is an argument that you can do a stock certificate. I understand that. But in some cases, you might even move cash over to the intangible side, depending on what's happening right now with the Fed. They're printing away. So you do have the physical cash, but it's devaluing over here. So we're going to get into that a little bit more. But there are some things that are kind of gray. The point is, when you have a tangible asset, you have something that you can actually physically have. And hopefully, some of these devalue over time and depreciate over time, and some of these will appreciate over the time. And of course, we talk a lot about the difference between buying something, an asset that's appreciating, and buying an asset that's depreciating. So that's all I really wanted to say on tangible versus intangible. We're going to kind of go back and forth on this now. And I know a lot of stock people, if you're a stock person, you're going to say, I have a tangible asset. Of course you are. Same with Bitcoin. Of course you are. But you can't, at my properties, I physically walk in there, see all my tenants paying, they're paying off my mortgages. It's a very different scenario. Same with the home that you live in or the car that you drive. That's tangible. Stocks, I wouldn't say as much. So first, let's go into the 4 asset classes. We talk a lot about this. There are 4 basic asset classes, and there are things that fall inside of there. Right now, we're seeing a lot about the stock market with obviously the Robinhood. You know how they shut down the trading and to protect the wealthy and protect the hedge fund guys, as they started shorting all these positions. They actually shorted over 100% of GameStop's stock, if you can even believe that. I don't even know how you do that. I don't even know how you short more than 100% of the outstanding shares. But if that doesn't tell you something, God bless you, brother. The second one is business, and obviously that's a business that you create, something that's yours. You can control the sales or the cash flow. I understand that there's a whole lot of work that needs to be done inside of the business, but at the end of the day, in my opinion, it's a lot safer than the stock market. Real estate, I'm clearly biased. I'm in real estate. I've been buying it for years, but we have millions and millions of dollars of monthly cash flow coming in on the real estate that we've bought, and we've been able to have our tenants pay it off over time, and we've gotten incredibly wealthy by doing this model. And then the last one is commodities. We're going to talk about gold and silver and all that, but those are basically, and this could be oil as well, but these are the 4 basic asset classes. So as you guys start to figure out what it is you want to do, just understand there's different risks, different levels of manipulation, which we've seen, different levels of control, and there's different levels of thinking, and some of these are super easy. So what happens, most people are pretty darn lazy, and so what they're going to do is they're going to buy stocks and they're going to buy commodities, and they're going to wish it on someone else based on something that they heard or something that they were told, and that's how the majority of investing is done. It's done off of faith and trust, and you hand your money over to someone else. These two here, they require a lot more knowledge and a lot more financial education in order to peel it off. So I would say if you're going to invest in stocks and commodities only and do it through somebody else, you're probably lazy. If you're going to do it here, then you probably are trying to learn financial education and probably do it yourself and probably trying to take a more active role on the managing of your money. So one of the things that you might remember on a video I did was talking about the different types of wealth. And so we're going to go over those now because I think that one of the guys that I really admire by the name of Chris Martenson wrote a great book called Peak Prosperity. And I really resonated with what he said here because he said that there are basically 3 tiers of wealth. There's what he calls the primary wealth, the secondary wealth, and the tertiary wealth. Now, what does all this mean? What does primary, secondary, and tertiary mean? So I'm going to walk you through the thought process of a commodity, let's say, or a business and how it works up through this category, and then show you what's happening right now. So down here in the primary category, you're going to have things like oil, you're going to have things like gold, silver, timber. So these would be like natural resources, as you guys would see. So as an example, like here's a silver piece right here. This is a 1 ounce, okay? And here is a gold piece. But the point is, these are down here. These are mined. So then what happens is entrepreneurs come along and they go, oh, we're going to figure out how to pull the oil out of the ground. We're going to figure out how to pull the gold or the silver or the timber out of the ground, and how do we turn that into a business? And so up here you might see, let's say Mobil, for the oil, for the gold company. There's a bunch of gold companies, mining companies up in Canada that do gold mining. You can go actually invest in those companies. Same thing with silver and timber. You might have a company like Weyerhaeuser, that goes and buys all this timber and then sells the lumber later. So you get the point here. Your natural resources are here, and the companies, the secondary wealth, are here. So those are the companies that are actually, there's some entrepreneur somewhere that raised a bunch of capital from somebody and said, hey, we're going to go get this oil, or hey, we're going to go get this gold or this silver or this timber, and we're going to turn it into a business. And then from here, we're going to sell it to consumers. In Canada, we're going to turn it into gold coins, and we're going to sell it into the gold market. Weyerhaeuser, we're going to sell it to the lumber companies, and then they're going to sell it to the builders, and then those eventually make it to the home builders, et cetera, et cetera, et cetera. So there's a process to all this. But what we want to stick to, and the whole point of this video, is what's in the primary wealth category. So now, what's in the tertiary category? This is where your stocks are, your ETFs, which are exchange traded funds. So now, this is what we would call paper. This is obviously business. And this is commodity. So this is the natural flow. And what happens, let's say let's say you're in the timber business and you start a timber company and you start buying timber, and the whole point of it is to sell it off, and you don't have enough money. What you do is you go to Wall Street and you turn it into a public company to where the public can invest in the stock of this company. But really what you want to be in is in these companies, or actually in this company. You want to actually own the timber that sells it to Weyerhaeuser. You know, you don't want to own it from this point. And so this is unfortunately where most of the public comes in. It's right here. They come in at the ETF on the stock stage because they don't understand or how to buy down in this category. Some of the early investors are going to come in at this stage. And so when you're looking at your risk, you tell me, is it riskier to be here at the top, or is it riskier to be in the timber company that sells it to Weyerhaeuser, that turns it into a stock and then buy the stock, and we just go through what you just already saw? Back in the 1929 stock market crash, this is where everybody lost all their money. At the end of the day, the people that owned the land, owned the mineral rights, and owned physical assets, even apartment buildings and housing, were the ones that were way better off than the people that had all their wealth up here. So the top tier here is what we're calling intangible. And these are tangible. So as you guys start to invest, I want you to be thinking this way. I want you to know that if you're going to do like everybody else does, set up a Robinhood account, throw some money in there, and start jumping in on here, you're at the very top of the risk scale. Now, there's plenty of people that would argue with me, but just use your best judgment. Would you rather own a piece of gold here or own a gold ETF stock? Because I already know that there's way more ETF gold exchange traded funds than there is physical gold. You could just Google and see that. Imagine this. Imagine taking a glass with an orange, and you cut that orange in half and you squeeze that orange, and the juice comes out. That's called a derivative. That's a derivative of the orange. And so what they've done is the same thing. The actual orange is actually what's worth the most. And as it gets diluted all the way up here and it gets turned into paper, then you are going to be at the highest risk. Your anxiety of your stock portfolio is going to be like this. Meanwhile, back at the ranch, you know, I've got, 10,000 apartments with people paying rent. Some aren't because of COVID, but generally I've got these physical properties that are making money, growing in value. The tenants are paying them off every month on the primary category, and that's where you want to be. So just this weekend, I was having breakfast with the founder and owner of The Chive. And many of you guys know The Chive. It's got millions and millions of people subscribed to it. They have Chive TV. They have all these things. And they own the rights to a lot of celebrities. And so John Resig, the owner, pulled out this coin with Bill Murray on it. And he had taken a coin and he was producing coins of Bill Murray in both silver and in gold. What he's doing is he's cranking out these 1 ounce pieces. And the reason is that John and I talked in depth about the difference between primary, secondary, and tertiary. As you move up, you're much more at risk here. And as he starts producing these coins at this level, they're going to be real money. Gold is God's money. It's money that you can take and stick in your pocket and go up to Canada and bring to a bank and get Canadian money. And it's a lot different than some of this kind of cash, as you guys might know. So I go around the world and I grab cash from all these different currencies. And these are also very, very, very different. But one of the things I want you to see is these Zimbabwe dollars. I don't know if you know, but the country of Zimbabwe basically printed their currency down to zero. And so what I have here, which you'll love and we'll put up on the screen, is a $1 reserve banknote from Zimbabwe, but also a $100 trillion note from Zimbabwe. A $1 and a $100 trillion 1 year later. This is 2007. This is 2008. If you don't believe me, just Google this stuff. You can buy these notes for nothing. The point is, as we start to fractionalize our currency, as we start, because we have a fiat currency, as we start to print, which is what we're doing now, you're going to start to see the currency will devalue over time, just like the Zimbabwe currency. So as you get further and further and further away from these natural resources, this is why if you go over 1500, 1600, 1700, 1800, you just look. The landowners and the people that own primary resources were the ones that generationally did the best over time. So let's just take a look at some of the top headlines right now. These hopefully aren't a surprise to you. If they are, you shouldn't be. But these are just today. Stocks mount sharp bounce backs as markets look to recover from the GameStop frenzy. Silver prices jump in GameStop-like frenzy. That means, again, that things are being manipulated. I don't know about you guys, but the stock market should not be on a run right now because most of these businesses are closed. And so what's driving it is investor frenzy, which means that what's not driving it are fundamentals like you're going to see in real estate. So if I don't have a tenant, I have no income. It's clear. I can't manipulate that revenue. There's no way to do it. They're either paying or they're not paying. So this is a very different game. And so you just got to decide whether it's for you or whether you want to get to something a little more tangible. One of the very interesting things that I found is that it's also very hard to buy gold. Now the question would be, why is it so hard to buy gold right now? There's one reason. Because everybody wants it. Everybody's afraid of the currency being manipulated. So of course, what did Wall Street do? Well, they came up with some great ways to buy gold through ETFs, but it's not gold back to the primary, secondary, tertiary. So be very, very careful. When you own gold, I'm not saying it's not going to do well for you. What I am going to say to you, it's a lot more risky than actually having it in your hand and having something tangible. Just like John is going to do for the Chive. He's going to actually produce a coin with some of the celebrities' names on them, and you'll be able to collect those coins, and they'll be real money instead of all this manipulation that you're going to have here. We talk a lot about this, but you really need to keep aware of this. This is the US dollar, the value of the US dollar since 1913. Yes, this is a long time. It's 100 years. But hopefully, it's an eye-opener for you. So what happened right here is Roosevelt said, everyone who owns gold needs to turn it in. And by the way, guess what I found? I found the actual executive order on the internet. This is the actual executive order. You know how Biden right now is in office signing all these executive orders? Okay, so this was an executive order from 1933. On or about May 1st, 1933, all gold coin, gold bullion, gold certificates now owned by them or Federal Reserve branch or to any member of the bank. So you had to deliver these under the order of the President of the United States. So basically they said you can no longer own gold. So obviously, what do you think that did at that point, right? Like at that time, like people were doing gold and they were, and by the way, a gold certificate was actually on a dollar bill. It would say gold certificate. They actually had it on a silver as well. So it would say silver certificate, gold certificate. It was actually paper money. So all those things had to be turned in at this point, and then you can kind of see that became one of the early stages of the collapse of the dollar. So as you guys can see here, that since 1913, the US dollar lost 96% already in basically a year. Now, is that a long time? Of course. But if you find any money from your grandparents in a coffee can, that's what's happened to it. It might be cool, but it's not worth very much. And this happened to me in Mexico as a kid when I went down there. I had gone previously and I had some pesos. One was a $500 peso note, and then the currency collapsed, and I went back down there a couple years later thinking I had all these pesos, and it was like worth nothing. And I remember they put this little coin that said clink on the metal countertop of the bank, and all my friends were laughing because I went down there thinking I had all this cash, but I didn't, because they just shut the door one day and then opened it back up and devalued the currency. That was in Mexico. That wasn't very long ago. So then again, as you guys know, somewhere down in here, this was Nixon. So that's when he took the dollar off the gold standard, and ever since then, it's been kind of riding down. So that's what you guys need to be aware of. And so as you start to look around and you start to figure out what is it that you can invest in, you can imagine this stuff here has held its value over time. It's not going to get devalued like paper. Either is real estate, because of the components of real estate, is a hedge for inflation. All of these things are going to be more protected than being up in the stocks and the ETF. So everybody's freaking out right now around all these different GameStop and AMC and American Airlines and now gold. It's all being manipulated by the markets. You're better off, I think, to be in physical, tangible assets. So the real question is how do we all survive best financially? So I think there's three things. One is control. Everybody talks about control, but turning your money over to a wealth manager, turning your money over to a financial planner, or investing in Bitcoin, or investing in something that's on a little bit of a run, I would not consider that control. What I would consider control would be a physical, tangible asset that you can move a tenant in, and you have a lease, and you make sure that they can pay, and you make sure that they're stable, and you run the numbers before, and you make sure you got your cash flow, and you negotiate with the bank loan. And yes, it does take work. Yes, it does take time. Yes, it does take financial education. But I believe that that is the best way to control your financial future, is to have somebody pay off that asset for you, which is exactly what real estate does. And you can get OPM or other people's money in the form of a loan and hedge inflation as the government continues to put more money into the economy and inflate the economy with more money and devalue the dollar. You're going to be able to hedge that through a fixed rate loan at the same time. So if you want to be in control, I'm telling you guys, you need to be in physical, tangible assets. The second thing is manipulation. Now, unless you're the one manipulating, then you're going to be up shit creek, because you're not going to be able to manipulate whatever you're in. You're not going to be able to control Bitcoin. You're not going to be able to control GameStop. You're not going to be able to control silver. But one thing you can do is invest in some of these things over the long term if they're physical assets. You can take that coin to Mexico. You could take that coin to Europe. You could take that coin to Canada. You can go anywhere you want, and gold is gold. You can trade it in for whatever dollars are paying at that time. You can't always do that with a lot of different currencies. So manipulation has been going on for years. It's going to continue to go on. And every single time the media is like, oh my God, what's going on? They're manipulating the market. It happens every flipping time. The only difference is that the little guys, they got Wall Street this time on the short with GameStop. And that's why everybody's freaking out, because the big guys aren't used to being gamed by GameStop. So the last one is the difference between cash flow and capital gain. So capital gain is nothing more than buying something low and trying to sell it high. Now, as you know, that did not happen for the hedge fund guys this week, some of the smartest people in the world. So this can be very, very risky. You just need to be careful. It's the same thing on a house. If you buy a $200,000 or $300,000 house and you sell it for $400,000, that difference is a capital gain. The problem is you take all that money and now you got to reinvest it again into a market that just sold at the top, which is happening right now. So you got to be very careful and try not to play the capital gain strategy. That's not a good long-term strategy. You're going to work a lot over here. If you can get this technique down and buy for cash flow, in other words, have a piece of real estate that pays you a lot more in income than your expenses and your debt, then you're going to actually have cash flow. And all you need to do is replicate that over and over and over and over, and pretty soon you're going to be plenty financially free on this side. And then you can play over here in the capital gain side if you want. But this should not be your primary strategy. This should be your primary strategy. You should develop your cash flow base and then use some of that over here because it is a much riskier place to be. So thanks for watching.